the mean, in the meantime, anything crazy happening today on Twitter or just generally in crypto?
Not that I know of personally.
Yeah, it feels like a slow day.
Yeah, I agree with that.
It's good to have those once in a while.
Yeah, exactly.
Yeah.
All right, I just tweeted a link to this event or Twitter space.
Nice.
All right. Think we're good to get started.
Cool, sounds good. So I guess the best place to start would be intros. So I can go first. My name is David Borick. I'm the founder of Sky, and just really passionate about building decentralized storage and decentralized applications. And I know that a lot of people in our community are kind of on the edge of, they have a project that they've been working on for a while in their spare time, and they're thinking it might be something that they could turn into a more serious venture. And so we really wanted to host a panel with some venture people in the space to kind of discuss topics around early stage investing and early stage projects, and to help give the community kind of context for what makes sense, and when that you're ready to go pursue venture funding. So I think we'll have everyone introduce themselves. So with the exception of Monsi, why don't you talk about your background, things you've done with early stage investment before, and then give one thing that gets you really excited about early stage investing.
I can start. Hey everyone, my name is Kinjal. I'm an early stage investor at Blockchain Capital. Thank you for joining today, and thanks for having me. So yeah, Blockchain Capital kind of focus across the entire ecosystem. I joined about 3 years ago, and originally kind of got into the space through Bitcoin and some of the work that I did at Fidelity Investments. But since then, have really been investing across the entire ecosystem. And I think, what's so fun about early stage investing is that a lot of it is kind of dreaming up what the future could look like with founders, and just figuring out what, the potential of blockchain and crypto could be in 5 or 10 years. And there's just a lot of creativity involved with that. And so I would say, as investors, we're pretty much focused on everything from infrastructure to once you have early users onboarded onto an application, where do they go from there? So we've invested in things like early exchanges, custodians, some DeFi projects, NFT exchanges, so on and so forth. And yeah, it's been a lot of fun. So thanks for having me.
I'll go next. I feel like the ping pong without video gets harder, so I'll volunteer. So I'm Kartik. I'm a partner at a fund called A Capital. A Capital is a early stage fund that focuses on crypto and non-crypto investments, and I've been doing this thing for closer to 5 years now. And most of my focus is directly on crypto investments, but most of my time kind of goes into looking at a lot of open source projects and initiatives or projects that are super technical, going on the productization side of things, and that's kind of what I particularly get excited about. And part of that is because my developer background kind of maps directly to that, and that's sort of something I resonate a lot with, and just is a lot easier for me to follow. And I've kind of been in this space for quite some time. I was before this, I had a background in systems, distributed system development, and a lot of architecting data centers. So that kind of got me into the early Bitcoin and Ethereum era, and I've sort of just been on that side of scalability related topics and themes, and that's sort of why I got interested in crypto. In terms of kind of how we operate or what we focus on, the fund, it is a multi-sector and a very broad sort of focus. So similar to sort of what Kinjal mentioned, we've done everything from exchanges to protocols to infrastructure services, and everything from kind of consumer side to direct open source applications. And we kind of look at it from a broad thematical standpoint, where we sort of look at what will be interesting as a theme or just an emerging technology that is ready to be productized in the future, and go into thinking about what is the best sort of place for us to look at for a company or a project or just an idea to be solved, and invest in those types of projects.
Cool. Okay, I can jump in too. My name is Casey. I, similar to Kartik, come from actually both people, but come from a technical background. I originally worked for the government after school in robotics, and then ended up going to Google, and have been at Google for the last 3 years, and have been working part-time at Bessemer, which is a global early stage venture fund, actually all stages right now. We just closed our most recent fund of 3.3 billion and announced that a few months ago. And while at Bessemer, I've focused most of my time on frontier tech. I think like the first question is like, why venture in general? And the reason I feel like that's the most pertinent question is because, you know, as all people that could just continue building themselves, everyone's kind of asked the question is like, why go to the venture side? And the answer for me is there's only so much I can build with my two hands, and there's so much I want to see done in this world. And it seems like a interesting way to scale my efforts, or at least like try to. So that's kind of the first, I guess, part of that answer. And then the second thing is like, why early stage? And for me, there's two big things. The first is that I am fully convinced that success is built at the ideation phase. I think there's so much more that can be systematized early on to predict and basically guarantee success. And hopefully we'll get into some of that later. But I've just always felt like people over index on the later stages when a lot of like the foundational and cardinal pieces get set within the first year of a company being built. And to me, that like Angel said, it's kind of where the creativity, the ideation, all that stuff happens, the technical differentiation, which I just find to be the most fun.
Awesome. Thank you, everyone, for joining. And David, before I let you kind of take us down this topic of seed funding, a quick note. So we'll do 45 minutes of just this discussion on today's topic, that's seed funding and how to go about raising your first 100K. And then the last 10-15 minutes, we can have, everyone who's joined us today can request access to speak, so we can bring you up if you have comments or questions for the speakers. So that's how we'll structure today's session. And then we are also live streaming. This is our first time live streaming to YouTube right now. So just in case someone's not able to join us on Twitter Spaces, that's an option available. Yeah, and I'm your host, Mansi Vora, and thank you again for joining. David, on to you.
Awesome. It's amazing to be here, and thank you everyone for coming. So I kind of wanted to open things up with the positive side of investment. So we're talking about companies that are like raising 100 to 200K. It's probably their first time raising to do a company, and the company is all founders, and they're looking to just get enough that they can, leave their full-time jobs or turn down, if they're students, turn down full-time jobs, and instead work full-time on their project. And so my opening question would be, when a team like this approaches you and gives a pitch, what are some elements or what are some experiences you've had where you walk away from the pitch thinking this is an easy yes, and this is definitely a deal that you want to participate in? And maybe we can have Casey kick things off.
Yeah, happy to. Okay, so because I'm a chronicle everything and write everything out, I actually like have a pretty, I don't know, reliable checklist that I return to for this kind of stuff. So I'm not gonna regurgitate it, but I think I have it memorized, so I'll try to make this sound natural. But like the first thing that makes the decision easy, and there's no one thing. Like I actually weight everything, and I have this Excel sheet that I do this in. But the first thing is like you as a team, and like the question that I always ask to proxy the quality of a team, because I find that to be incredibly subjective, is would I work for you guys or work with you guys alongside? Like, would I actually quit my job at Google and come work on this? And that's like something that, it's a little bit intangible. It's not like, are you articulate or are you passionate? It's just like these unconscious or subconscious cues that we get in terms of trusting an individual. So that's the first thing. And then the second thing is trying to suss out if this is going to be an amazing product. And obviously at this stage, which David described, you might not even have a full product. You might have a MVP. You might have an idea. But we want to play the tape forward and try to figure out basically like, is a clear problem being solved? Is there a step function in value? And do you believe the assumptions needed to get excited? So like I try to think of every investment as either like a tree structure, like in computing, like a decision tree, or like a house of cards if you're not familiar with computing principles. But the analogy is trying to show that there's like always these like links that you have to believe in order to have conviction about a deal. And I think being as explicit as possible about those up front clear up like a ton of cobwebs. So I try to like make a dependency chart, which is like, okay, if you believe like, Bitcoin's going up, and then you believe that like DeFi is going to be a thing, and then you believe like whatever, then you get to like feeling comfortable exposing capital. Those are like, I'll pause there because I don't want to like ramble, but those are like the two top things I try to decide. And if I can walk away being like, yes, this is a tier one team, and yes, I think this is an amazing product, believing all these necessary assumptions, it's like an obvious second meeting for me. I don't know if that made sense, but
Yeah, it certainly makes sense to me. I'm curious if Kartik or Kinjal have thoughts on that, and if your process is similar or if there's something different that you look for.
Yeah, I'll go next. I don't think the answer Casey gave is too different from what I would say myself. Oftentimes, kind of maybe one thing I would say is like I know David, you asked that question in particular for like the first 100K or the first kind of really small capital in, but I think the framework is relatively similar for independence of kind of the amount being coming in on the early side. So when I kind of look at somebody or when I'm talking to a founder, I am particularly interested in understanding what is it that they're doing. And on top of all of that, if I have any kind of indication that what they're doing is that they're the best people to be doing that. Kind of the types of projects that I mostly talk to are developer tools and sort of technical projects. And in those sort of cases, it often ends up being a check around for the problem that they're pitching me or the space that they're focused on. What is kind of the state of that ecosystem or problem, and are they the best teams or the best product that's out there for that particular problem space, and are they the ones solving this? And oftentimes, what I'm looking at is assessing kind of the insight that the team has on anywhere from the abstraction that they're putting in for there's I feel like I'm trying to be too abstract here. So if, for example, they're working on a developer tool, is that developer tool actually the right abstraction for the problem that they're trying to solve? Is it a improvement on top of the usability side of it, or is it an improvement on the performance of it? And just more specifically, kind of compared to what else is out there, is that the best approach to what I think or just what the team thinks, and but also does that match with what I want to do? in the kind of areas I look at, which is mostly on top of kind of things on Ethereum and just smart contract related protocols, that becomes a lot easier to at least qualify what is good and what's not, because either I'm a direct user of these things or I've talked to enough people who are working on similar things to have a relative sense of what interesting is. And if you kind of have a good answer for this is a really cool product or approach or a unique approach to that same problem that everybody either knows or is complaining about, is this the best team now solving for that? So if they have that checked, then the kind of questions become, is the approach to how they're productizing it is good or not? And that often is a result of, in the early stages, obviously there's so many things that can change over time, and you don't want to spend too much weight on, or you don't assign too much weight on focusing or just sticking to just exact one thing or not. But it often ends up being knowing who are they going for, and if so, or based on where they are at that stage, I'm talking to them, do they have any confirmation of that being the right track or not? So if it's a developer tool, have they already gotten feedback from their potential users or other developers? If they're going for a consumer related product, have they already prototyped something that somebody's trying? Or if it's something more on the infrastructure side, what is the actual trade-off that you get for picking this solution over the others? And these are kind of the qualifiers I would use initially. And from there, as I kind of go through, similar to what Casey said on her list, use that to assess and spend more time on learning more about the team and their approach.
So for these really early stage deals, how important is progress to you? Like, do you expect there to be a shell of a product, or can it just be an idea? Like, what types of what types of groundwork do you expect to already be in place?
I think this is like such a good question because I think the answer is actually really clear. So at least in my opinion, it doesn't matter at all where you're starting. It matters your rate of change. It's like a physics problem. Like it's like inertia. Like that's what you're solving for. Like you want a team that's agile and fast and moves at a rate that is going to be able to innovate. So it doesn't matter. Like you could come in with a napkin. The better question is like next week when I call you, where are you? That's in my opinion.
I love that, Casey. I was going to say something very similar where I think like it maybe matters less of where you are in that moment, but how determined you are to test assumptions with the market or test features or test ideas or whatever it may be, but like actually go out and find some sort of validation, yes or no, against what you're trying to build. I think is just like a great sign that this is a team that's going to find where they're going to end up in 12 months because they're going to continue to iterate on it, versus like coming in with a completely polished product. I think it's more about the process.
I absolutely second that. I think they're I think that just the word early stage is such a broad kind of catch-all that you can be early stage if you have just an idea and nothing else, or you can be in some cases like a consumer product with 1 million users and still be early stage, and everything in between. In terms of kind of at least what I particularly look at, I think it's often having a initial direction on what's happening with the set product. In the case of developer tools, I think it's usually rare that somebody just has an idea of really cool, anywhere from open source project to a company around a public utility, and I usually don't see something with you don't really see those types of pitches without actually anything to look at. So those types of things are rare. I think when you look at something like a protocol, oftentimes, even if they may not have everything built from like a application or like from a code base standpoint, there's still references to the inside, whether that's, hey, we have a unique anywhere from consensus mechanism to, or if you're a DeFi protocol, hey, this is how we're structuring our contracts to kind of do this trade-off. Like there's usually something to go on for, and that helps. But that's just a starting point, and kind of what matters is just how fast are you trying to test those hypotheses and move from there. And as long as that rate of change is positive and ideally growing, that's how you really know what is and isn't working.
Awesome. And before we move on to our next kind of question, I wanted to touch on valuation and runway, and like how much should, say, like a team be asking, whether it's like a team of one or a team of four, and how much equity should they be expecting to give up, and like how long do you expect that money to last?
I'll take an attempt at this one. You're gonna likely get a non-answer for me, mainly because there's no way to generalize this. I think I'll kind of give some frameworks. I feel like the saying any number is not going to be super helpful just because it's going to depend on the type of product you're working on. If you are in the super early side, which is you have just you and your co-founder, or like there's just a co-founding team, whether it's 1 or 3 people, and this is the first time you're trying to raise any capital, I think what matters is kind of thinking about, hey, we're kind of just embarking on this as a mission, and I'd like to, or you'd like to ideally set aside a window for you to test things. And by default, 12 to 18 months is a good time for any type of fundraise to suffice. So if it's just 2 people working on a new company, ideally, like this can apply for 200K for that team to cover basic salary and expenses. Or if it's two, and you can kind of think about scaling that directly based on how you would like to ideally grow. And oftentimes, I think one thing you should sort of keep in mind is that the first thing is like raising money is not required in the sense of like not everybody needs venture. Usually, the types of companies that are suitable for venture capital are the kind of the companies that are trying to grow much bigger, and usually you're raising capital to actually put that to work in order to keep growing or kind of amplifying whatever the loop is that you're trying to grow. So from that perspective, you should raise money anytime and enough to give the current team and a function of how you're going to grow in like the next 6 to 12 months to just sustain themselves for that 12 to 18 month window. And from there, um, think about what needs to change and kind of what the next milestones will be for you as a team. So 2 people can easily think about 250K and raise that and sort of get started. But then that money usually works in, that money should be used to test out the initial kind of hypothesis and plan to really say, hey, now we've accomplished this plan. Let's now think about raising either more, or we need to now finally grow the team because we just needed that much money to work on the product that is kind of resonating with our users. And let's kind of throw more engineering or more support or whatever we need to do. There were a couple other parts of that question, but maybe I'll let others sort of chime in as well.
Yeah, I can jump in. I agree with everything Kartik said. There are 3 major ways to calculate valuation that I've seen over my last 3 years at Bessemer. And David, I mean, like I'm happy to walk through the methods I've seen if you feel like that would be helpful, but I can just maybe surface the one that I feel like is most relevant for early stage, because the way you calculate valuation definitely changes as you move into growth equity. But for early stage, it's a reverse engineering problem. You, like Kartik said, you should take your P&L and think about who you need to hire and what happens to OpEx and who do you need on your team to hit those milestones. And most people today are building software businesses. You have great margins, you have low CapEx, but your OpEx is really where your balance sheet suffers. And from there, you figure out how much you're going to burn, aka how much are you going to grow, because it's the same thing. There should be a clear relationship between your burn and your growth in terms of revenue or bottom line metrics. And then you figure out from there in the next 2 years, like that would be the number that you're going to want to take on roughly. And then valuation is roughly, like, again, no hard numbers are super helpful, but roughly 20%. The other thing that's like really popular is in terms of like valuation, it's often just a multiple of ARR. Again, like for these early stage deals, this is why I didn't really think it's helpful to surface this. But if you are in a position where you're producing revenue, it's usually a multiple, and that is totally industry specific. So for like hot SaaS, I mean, I've been seeing deals done at like, I don't know, north of 30x revenue right now, which is absolutely ludicrous, but that's just where the market's at. But this is all like Googleable. I'm guessing most of the audience is in crypto, but crypto has its own multiple standard, but they're usually bound by the like domain that you're tackling.
Last thing I would add is also just considering market dynamics when you're raising. So there's obviously certain times where market valuations are significantly higher during a bull market versus a bear market, and that has a relationship with obviously just overall competition and the amount of founders that are kind of entering the space. And so just, I think being really like pragmatic and thinking through your burn rate and like how that might may or may not change depending on how the crypto market cycles are going to change, I think is just an important consideration unique to this market in general, because we do have these fluctuations that kind of happen and are difficult to predict. So I think just like keeping an eye on when you're raising and how that kind of fits into the overall market cycle and what that may mean for raising in the future, I think is just an important consideration.
Maybe one, actually, I think Kinzo brought up a really good point, and one thing I'd like to sort of add is oftentimes you also want to just think through what the next couple of rounds would look like if you're planning on really sort of going all in and raising more venture capital. And yeah, 10 that sort of anywhere from 10 to 25% per round is kind of the range you'll have in terms of what's being given away to the investors in these sort of cases. And while there's no kind of rule or standard that you want to adhere to or really abide by, it's just going to be different for every particular company and every different scenario. Usually you should just keep in mind that you are not giving away too much of your company early on to investors until either you have a good sense of that this is product market fit or we know that this is finally working. And kind of the reason for that is if let's say you give away 25% of your company in the seed round and another 25 in the Series A, that might be a decent kind of framework that you would want to be with. But if you say, I'm going to do a pre-seed round and you give away 20% there and you do another bridge round where you give 10% to somebody and you do another seed round, that's 20% again. And by the time you get to your Series A, you are more than 50% kind of diluted. It just doesn't set up the team to be successful in terms of anywhere from incentivizing employees to future rounds or anything else. You also want to be careful about how much dilution you're taking on early. And if you can get away with not raising too much capital, not giving away too much of your company equity to other third parties or just outsiders, then it's just better for you because it gives you that leverage to actually grow more in the future when things are working or working really well.
Awesome. I think those are great answers and give a lot of perspective. So I kind of want to shift gears to more of like red flags or yellow flags, where common things you see, especially with first-time entrepreneurs, where they come in, they do a pitch, and things are going well, you're getting excited, and then they say something or something happens or they reveal part of their plan, and it just kind of kills the excitement or kills the deal. And so, what are common, like, I guess just mistakes or misunderstandings that you guys run into from in particular first-time founders?
I can start. This is again like I think something that is potentially difficult to make super tangible. The first and foremost question is what Casey had brought up previously, which is the team and would I work for this team or would I work with this team? And so while that answer can be resoundingly yes, sometimes there may be something about the just like the communication that potentially turns you the other way of, hey, maybe there's some red flags just in terms of the team's fit together and with the market and so on and so forth. I think one area that in particular in crypto I tend to gravitate away from is an overemphasis on like an exit strategy or lack of a longer term vision. So I think like talking to when I am speaking with founders and they kind of jump the gun to like, and this is how we plan on this is kind of like the beginning and the end of the story of their company or protocol or whatever it may be. I think that's something that just makes me pause because in many ways this is more of a like, you come in and you're talking to an investor and you're selling this longer term vision of, hey, this is what this could become, and not so much this is how we kind of wrap this up. So that's just one little thing that I think I've seen in a few different conversations that can sometimes send the wrong signal to the investors. But but yeah, it is something that's a little bit less tangible of like, this is exactly, you know, a red or yellow flag, at least for me.
I'll kind of add on to this. I think I I wouldn't call them necessarily mistakes. I think I've definitely noticed a handful of patterns around this, and usually the cases that are common to me are when I'm talking to super sort of technical founders who are first time in because they worked on some protocol or they worked on some open source projects, and now they're thinking about turning that project into a company, and that sort of mindset from a developer to now a founder or CEO or whatever in a broader sense kind of comes into play. I think um, oftentimes kind of the thing that sort of ends up at least standing out to me are cases where uh, I think there is I got to be careful about how I say this. The oftentimes there is a clear bucket that they prefer to kind of own, and what that ends up being is it ends up being scenarios like, hey, I'm like let's say I'm a developer for a project, and there's like a team of just actually two people, and basically they often end up only owning the thing that they really like. But you're trying to start a company, and there's a lot of other roles and hats they need to put on, and often in cases where you can sense that they are refusing to address every other thing. It's not like they're not perfect for it. It's more about they would choose to only own the thing that they're really good at, and sort of not do anything else in the early side. And kind of the hard part about starting a company is that it's a lot of risk, and it's a lot of things that you have to do to kind of get to where you want to be. And oftentimes it requires you to do things that may be either anywhere from outside your comfort area to things that may not be your favorite things to do. And sort of just choosing to anywhere from refusing to just not prioritizing the rest of the things needed to become a successful company sort of ends up very noticeable, at least to me. Um, and the second kind of pattern I see a lot is and this is not a necessarily a bad thing. It's just more about it requires a bit more time for everybody to see as they sort of switch gears from anywhere from being a developer to being a founder or running a company, which is in a way kind of pattern matching to the near term and extrapolating from that. And these are kind of the cases where I'm sure a few of us have seen in the past is you look at some initial growth and anywhere from like a spike in usage to a spike in kind of just people trying things out or just a lot of inflow for you launch something and a lot of people came in and you use that as a way to say, look, this is confirmed, this is going to go, or this is going to keep growing, and you're just kind of using a little bit of data to extrapolate a potential future, which may or may not be correct, and not being able to kind of think about what this would look like in different kind of stepwise cases where, hey, this we got like 1,000 users in the first hour, and now like does that mean we can get more or we can consistently keep this going, or should I not think about why our like what would take for us to increase that or keep this sustainable or keep this steady for the next whatever little while, and being able to think about what that long tail looks like, I feel like is a pretty important piece that oftentimes requires a bit more of a workout to kind of get used to and warm up to, and just kind of being able to say that they are focused on not just what's working right now, but also what they need to be true for this to consistently work for the long tail, whether that's a long tail audience or just a long tail set of assumptions or prerequisites needed to for the product or the company to be successful. How much thought have they given to that, and are they consistently thinking about that, even if it may not be the perfect time to execute on the future?
So I think it's interesting. One of the things you brought up, which is that starting a company requires a very broad set of skills, and like there are a lot of things that have to get done. And if you're a first time founder, it's almost guaranteed that you don't have those skills. So I guess there's a question of like how how do you get these skills? Where do you see these skills, usually coming from? Do you expect some sort of like advisor structure? Does it help if the entrepreneur has been through an accelerator program before, if they have advisors, like what do you look for that helps validate the idea that this first time founder is going to be able to figure everything out?
Anyone else want to go
Wait,
first?
well,
Casey,
I
go
would
for
just
it.
like to clarify. Okay, actually, can I just, to our previous question, David, sorry to jump around, but can I just offer like two more tactical tips that I feel like happen a ton in my day to day that I feel like all founders should know?
Yeah, 100%.
Okay. Because I know we've been speaking a little bit high level, but like two things that happen like every week that I'm just like, somebody needs to make this more readily available information is like, I the way like VC schedules are set up is like meetings are like stacked and like you can't really go over because like you end up being late to the next meeting. And I remember like as a builder and as I kind of like juggle these two worlds, it's very different because you usually have like blocks of time, but VCs usually have 30-minute slots. And every time a founder goes over, I hate this, but I just inherently get frustrated because I'm like, oh my gosh, like I'm gonna be late and all this stuff. So if I feel like founders should know that sticking to the time slot is preferred, and even if you're having a great conversation and it's like, oh, we want to go over, so I feel like we're having such a great conversation, it's actually going to do you harm rather than good because then they're going to be late and then they're not going to like get to write their notes, and it's just like in everyone's best interest to finish the meeting on time. So like watching that is really crucial, and I just want to say that explicitly. And then the other thing is like I think that there is sometimes like a misunderstanding in how much time we've spent before we talk with you. And I, in a perfect world, would spend like an hour before meeting with every founder, but that's just not the nature of the job normally. And I'm not going to speak for everyone else because maybe other people are better at this job than me, but the reality is I've probably spent like, I don't know, 15 minutes maybe reading what you're doing, and like that's generous. And because of that, like being able to synthesize information and communicate what you're doing without assuming any prior understanding is so crucial. And unfortunately, like if you're not able to do that, what often happens is people think, oh, they're too in the weeds, or oh, they're not a great communicator, or oh, they're not inspiring. But really, like what's probably happening is that you're assuming that I know more than I do. So I think just like having this assumption that like we don't know that much and like walking us through the basics is like something I constantly have to tell people. And uh I feel kind of shitty saying it because like as a builder I empathize with you and like everybody should be well versed in things, but it's I don't know, it's just difficult. So those are my two tactical tips that I feel like I wish I knew when I started a company. Unrelated, David. So we can go back to the question, but wanted to add.
No, thanks. That's super helpful, and I think that is the type of thing that we're looking for. I think a lot of as you were saying, a lot of people have never been on your side of the table, and they don't understand what just what the mistakes are. Their world is very different from yours.
Yeah, exactly.
So David, going back to the other question, I guess there's a couple of different ways I think about this. So, um, you know, just to like restate what you asked, you're talking about having advisor involvement or juggling a lot of different roles, and how do you kind of best deal with that when you're starting a company and kind of solve for maybe areas where you're not an expert effectively. Um, so I think like a couple of things. Advisors, I think, there are advisors that have been really, really great to have on a day-to-day basis, just like early on, someone to bounce ideas around, or somebody who has a particular area of expertise that you can't hire for right now, but is going to be a big play a big role in the early steps of your company. And so I think in those instances, having an advisor has proven to be great. But I will say that there are definitely teams that come and raise and have like a completely stacked advisor list, but they don't really talk to their advisors. So I guess I would say like it's super variable, and I would stress that if you're going to have advisors and that's going to be like a major major part of like your, I guess, like the CEO's like you know team per se, then I would just like stress what their involvement is and how they are helpful versus if it's more of like a light touch kind of arrangement, because I've seen like the entire spectrum. And then I think the other piece is that just like understanding what areas are not going to be your strengths and how you can still involve yourself in that process, but potentially focus your energy on finding the best person to do it for your company. So, kind of hiring amazing talent is probably one of the most important jobs for any early stage company in general. And I think like understanding what areas you maybe want somebody else to come step in and help you out with that is just something that I think I've seen certain founders do really, really well, and kind of can stack their team accordingly from the very early days. And if it's really just pre-product or you're just getting started, I would say that finding other founders, and sometimes accelerators are great for that, of like finding your own support group of folks who you can turn to and say like, hey, I have never dealt with like compliance or payroll or like whatever it is before. Like, how do you guys do this? I think can be super beneficial from that angle. So that was a bunch of different strategies, but I've seen all of them work in different instances. It really is situation dependent.
I don't have a too differentiated answer either. I was gonna say something similar as well. Kind of the part of the reasons why it's ideal to have a co-founder is because you are working with somebody who's complementary in skill sets and is able to take on certain things that you either may not enjoy or not really good at. And it kind of works the same thing for the other person. And that's kind of why you see a lot of combinations where somebody's really good at kind of communications through the business side or the people interfacing, and on the developer side, not that it's a great recipe or like any other combination is not good or whatever, but this is usually kind of what ends up happening. That sort of network is sort of what gets people started, because you still have to do all these things like any other company would, but you're able to take on a lot more work that is interesting to you and still get the goals accomplished. And also, this is exactly why you would fundraise. You know that this is what you need to do to get something done, and the capital helps you accomplishing that. And that's anywhere from hiring to thinking about automating to thinking about just throwing money at some kind of trivial or sort of problems that don't necessarily need to take up your time as you are growing or as you have to make more time decisions. The other piece, I think you kind of touched on the incubator stuff, is that that's also sort of the role that incubators and I guess even advisors play. And oftentimes that can be, in my opinion, generalized to being able to find an okay solution to certain things. And that sort of is like in the form of anywhere from playbooks to, hey, I tried this thing before and this works really well. And the worst case, you can try this side of how we do things, whether it's like, hey, you should read this post or you should read this approach on how do you do sales, to we need to have these basic things figured out every time we do a launch. Like all these things can be sourced together and sort of collaborated on from people who've done this thing in the past, and that becomes a really nice way to fall back on. And these are the types of scenarios where anywhere from advisors to other people or other founders in your network that you know, to down to incubators who are helping you sort of figure out what is it that you need to get to product market fit, can help with. And these types of resources are great because until you have the perfect person or answer or the amount of money to kind of really solve that, you have a good solution that works in the meantime. And yeah, and that's the place where they all fit in.
And so maybe this question is related to what Kinjal said about having a support group or having other founders and having proximity to advisors. But how important is location in your guys' mind? And so, like for example, if someone's based in Europe or is based, in a rural part of a flyover state, should they expect that they'll be moving to somewhere like San Francisco or to some nexus where there are a lot of other startups? And how important is that to you?
This is a hot. Oh,
yeah,
go ahead.
go for it, Kinjal.
I was going to say, this is a hot topic, and I think everybody has, everybody has an opinion on working remote or not. I guess the way that I see it, particularly with crypto, is that, crypto is like a global phenomenon. It feels like everyone in this world, spends and lives their lives kind of interfacing with our online friends and doing all these things online. And so to me, it feels like it's, your objectives are achievable um, pretty much anywhere in the world. But what I will say is that, I think what this translates to in a non-COVID world is when you are living in cities, whether that's San Francisco or New York or whatever it may be, where you're surrounded by people who are facing the same challenges that you might be facing, and you can kind of, start meeting up with people and building a more in-person community. I think that goes a long way for few critical milestones as like an early founder. So I think it goes a long way for recruiting talent. I think it also goes a long way for just like founder support, and probably to an extent like just mental health support. And so I think like being in person has a lot of benefits that you can't necessarily get from being remote only. But I guess I would never say that you can't build anything anywhere in today's day and age.
I mostly agree with that. I think the way I would kind of separate the parts I don't necessarily kind of have a 100% answer on this thing is that there are a lot of cases, or a few cases, where it is actually relevant to be in a place that helps you succeed from a customer standpoint. And oftentimes when you look at, this is not an entirely crypto argument. I think it's more of a, in the traditional sense, if you are an enterprise software company and you're selling entirely to anywhere from startups to big organizations, and having them kind of buy your product, it is generally helpful to be in the vicinity of where they are, or where your customers are. And that type of thing just helps with anywhere from sales to kind of maintaining and building those relationships that may eventually get you to get you them as your customer. So those types of scenarios are super helpful. Long term may not necessarily be a deal breaker in the early side, or until you know that you are the best product out there and you just need to grow. And that's also kind of why you would notice that for product teams that are not even in the US, they often have like a sales office or kind of some present in Silicon Valley. A lot of cases where that's where the customers are that they're trying to sell to. The other piece I think in crypto may be relevant is for some cases where your product relies on regulation or just a really specific geography to exist. If you're obviously working on a centralized exchange, you probably want to make sure that you are in a jurisdiction that helps you succeed for that particular exchange, whatever that country or location may be. And in those types of scenarios, on the early side at least, I think you should probably not gamble too much on just kind of being everywhere, or rather too global. The second piece is, I also think, sorry, maybe just to counter the other one, the parts I do agree with it is that if you're working in a general software product, I don't think it matters where you are. And this has kind of been proven true in the last 12 months. I don't have a specific preference. I don't think it really hurts your goals. And if the goal is to build a really good software product that is open or usable by anybody out there, then as long as you can make that work anywhere, it works really well in your favor. And I think if anything, you actually have access to a lot more talent. The only thing I would sort of say, in addition to the first couple of points, is if you are just starting a company and it's just you and your co-founder, or just the early team, let's say like 2 to 5 people. In the case where you are just getting started on the product and you don't have anything built yet, or you're just in those phases in the first few months, I think it's just helpful to have everybody in the same place, just because you can get a lot more things done faster, and also just that initial excitement and that momentum carries a lot. And so I would still say if you have the opportunity to make that work with just the early team, that is a plus, but it is not a rule, or I don't think you have to do that.
I agree with that.
Awesome. Thanks for the answers there. And I think we're to a point where we can kind of open the floor to the audience. If anyone has questions for the panel, we can start collecting those.
Yeah, so I guess if anyone wants to join us, you just have to request access, request to be a speaker, and I can add you, and then you can ask those questions, or if you have any comments about the conversation we had today, feel free to chime in. But as we are getting those, maybe a question for the panelists, and Kinjal and I have discussed this recently. The crypto space is currently really hot in the sense that investors are now competing to invest in companies. So, can you talk a little bit more about that? What you're seeing right now, currently in the market? What kind of products you're seeing? What kind of companies you are, excited about investing in?
Yeah, I mean, do we want to stick to crypto, or what kind of industries do we want to chat about?
Yeah, if crypto would be great. I think majority of the audience is from the crypto space.
Yeah. What am I most excited about right now? This is like a very narrow answer, but I think that we're gonna have a new wave of on and off ramps, and I think we've already seen like the first generation with like MoonPay and Simplex, but I think there's gonna be like a new generation of them, and I'm really excited for that. I also think that microtransactions are finally going to have their day, and I think they're going to be tied to like this word that we've all been hearing a lot, which is like the metaverse, which is going to be kind of pushed forward through NFTs, hopefully. But with that, I think we're going to finally see like a real use case for microtransactions, and that's something that I don't know, I've been dreaming about for a long time, and I've gotten the timing wrong there, like year after year. But that's really exciting to me. Although, again, like we need a little bit more proof that it's going to materialize in this next wave. And then I'm going to stay clear of the word NFT because I hear it, I think 70,000 times a day. But the word collectibles, I will say, is like probably, in my opinion, the most successful consumer application of blockchain so far. And that's interesting because it opens up the world of consumer to crypto. So instead of just like fintech investors being interested, now all consumer investors are saying, oh, we need somebody that understands crypto. We need somebody that understands crypto. And that's like, this is obviously just the beginning on that front. So just like, what's most exciting to me is crypto bleeding into different industries. Crypto is like a means, it's not like an end, it's like a tool kind of that's going to, I think, become almost like ubiquitous across multiple sectors. And it's really cool. I don't know if anyone's ever read the book Range, but this idea of like bridging multiple disciplines and using crypto as kind of like the driving factor behind it, that's what gets me kind of up in the morning.
Yeah, I guess a few areas that I've been spending a lot of time on that I think are super exciting is one that Casey touched upon, which is just, finally, I think seeing some more consumer applications. And not to use the word NFT, but I think like the question of what do you do now that you have the NFT is just like one that's going to be really fun to explore. So what are some of the experiences, whether that's, in a virtual world, or what are some of the ways that we can start using different NFTs as like a tool for distribution of content, or just like connecting creators with their fans. I think that just in general, everything that happens after you purchase the NFT is just a wide open space, and something that I'm super excited about. And then just one other sort of bigger category that I will mention is what I kind of call protocol to protocol services. So I think there's going to be a lot of like P2P opportunities in the future, whether it's thinking about, customer service between using one protocol versus using another protocol, or thinking about treasury allocation and tools to manage your treasury, or governance. I just feel like there's this, emergence of a bunch of tools and software that protocols are going to be using to grow their networks, and then also to kind of interact with one another. And yeah, I think it's going to be something that allows the space to expand not only the number of users, but also kind of bridge or grow protocols to the next level in terms of their scale. So I think that'll be really fun.
And on my end, I think the category I'm currently looking into and excited about is just capital efficiency, specifically for DeFi. And kind of what that translates to is there's a lot of obviously activity and just kind of growth in the sector. And we're seeing so many financial instruments and protocols sort of come out, and they've been really successful in gaining a lot of capital or just TVL locked up. And I think we're going to see a wave of protocols that are going to make the capital that's locked in to be a lot more efficient, anywhere from freeing up the capital to making composable applications to different instruments a lot more cheaper, anywhere from just the gas side to just reusability of existing sort of IOUs to bearer assets. And I just think we're going to see a much more or just a new wave of existing protocols or versions of existing protocols that are going to allow us to unlock a lot of the capital that's already locked in and use that in the more creative or just even different use cases. So just that DeFi category is what I'm particularly spending time on.
I liked how both Kenzo and Casey we don't want to use the term NFT, but okay. If you want to ask your question, I've added you as a speaker.
Cool. Thank you so much. Hi, everyone. I'm Joaquin. I've started different startups in the past, and you guys are making me want to get back into the crypto development space. Very cool conversation. My question is very basic. I've never raised seed funding, and so I want to know if there's a simple agreement, or a simple template that's available in order to do this, and also if there's sort of some blind spots in there for founders, and what are the points of negotiation in these templates? Thanks so much.
Wait, sorry, template for what exactly?
So if I'm raising seed money, right?
Mm-hmm.
Like what's in this agreement? Like, is there a template for seed, seed funding, right?
Oh, yeah.
Yeah.
I can take this. So, like in terms of, tell me if I'm misunderstanding the question, but like if you're going to go raise capital, you normally raise, and there's like multiple vehicles in which you can raise funding, and this is like in traditional equity world. So I'll let somebody who's a little bit more on the crypto native side right now answer it in terms of tokens. But if you're looking to actually give away equity, you're probably going to raise on a SAFE, which is an instrument that was created by YC. And then there's two types of SAFE. There's a pre-money and a post-money. And this actually is low-key a huge difference. And I think if I was a founder, I'd want to know. So the post money is actually the new YC safe, and it's actually less founder friendly. And I'm not going to bore you with why, but the point is okay. I mean, yeah, I can give the argument. I mean, I've been dealing with this all week. It's been a huge headache.
Yeah,
but
I'm happy to learn whatever you know, Casey. Really appreciate it.
Well, basically, like the pre-money safe was designed in a way where when you stack them, so let's say like you go raise another round of money and you do another safe, everybody gets diluted. Everybody, like the original safe investors, the new safe investors, everybody does. But the post-money safes, only the existing shareholders get diluted. So what ends up happening is the founder just ends up losing so much more of the company. And it can be a difference of like multiple percentage points. Like the company that I'm working with right now, which will remain nameless, they went from like 8% to like 5% because of using post money safes, and they didn't even realize it. And I think the consequences just obviously get compounded as you would raise additional money. So this like ability to stack safes is like something to be aware of. But yeah, that's how you would raise it, and you can Google it. And the YC safe is incredibly simple. It's basically like just a convertible note that has zero interest on it, like no discount, like just a really, really plain way to take on capital. But that's again just on the equity side.
Cool, that's great. And then also like, are these safes ever negotiated in a different way, right? Like does the actual contract end up different than the original template as well?
Yeah, like if a reputable venture fund wants to change it, they can. But often, like when somebody sends you a term sheet, so there's like two things. There's like the instrument that you're signing and then the term sheet, which kind of like indicates the terms, and like that's kind of where the nuances will come out, where they can like specify board of directors and kind of like how much percentage of the company they want, and like what like the pref stack is, and like liquidity preferences, like all of these kind of more nuanced things of like what happens when things go right, and more importantly what happens when things go wrong. But I would say like at this point, although like the pre-seed rounds and seed rounds I see, like traditionally there's no amendments made to the YC safe. But I'm curious to see if anyone else has experienced something different than that.
I think that's generally, yeah, I think that's kind of the case. So Y Combinator sort of spent all this time standardizing early stage kind of venture, and kind of the first comment I want to just sort of share is that obviously this is none of this should be kind of legal advice. You obviously still have to kind of consult and understand how this would map to your particular case. But if you're just kind of getting started with the company, your goal is to just get the fundraising going, and there are no special cases. If you're not a crypto company, there's like no whatever, or if you don't have a crypto token, whatever thing, it's going to be very kind of vanilla for you. And you can look at that safe template, and that template just says these are the rights to equity or future equity in a company, and the only thing you're kind of looking at is what is the valuation that you're going to fundraise on. And the safes work just like it's kind of the equivalent of just owning a percentages. If you're trying to raise at a $10 million valuation and you're using the post money safe and somebody's giving you $1 million, they own now 10% of the company, and then that's kind of just the math. And the safe says this is the legal agreement that I have the right to own 10% of the company. That's pretty much what you generally need in a normal case. You can get that signed and you can move on, and as long as you have an incorporated entity, that sort of represents the claim for an investor to rights to shares in the future shares of a company. When you are raising more capital in the future, let's say you kind of go into a professional VC fund or a later stage fund, Series A or anything after, and they said we want to now give you a term sheet, which implies in kind of more common cases a preferred round that they're going to do, which means they're going to convert the safe and set up a cap table, and now every share becomes an actual every safe becomes a share ownership agreement on the cap table. That's when you need like a full legal sort of team to assess everything and then go through all that process, and the safes are a way to say, hey, like now when you're actually setting up a normal cap table, I now have the right to own 10% or whatever percent of the future equity version. So oftentimes nothing changes on the vanilla side. I have seen a few cases where some people have tried to raise for their crypto companies with a normal safe, but they've amended and added a section that says if in the future a company were to do tokens, then the investors also have a right to a proportional amount of tokens instead of just equity. So there have been amendments that I've seen, but there's no standard template that I think exists to my knowledge.
Thank you, Akin.
Yeah, thank you so much.
Yeah, thank you for joining. We have another question from Usman.
Hi, everyone. First off, like, thanks again for this opportunity. So my question is going to be somewhat very vague, so I do apologize in advance for that. I was wondering, what can someone who has very beginner level knowledge do to learn more about the crypto industry and get more comfortable in this new world?
Yeah, it's a wild world. There's definitely a lot of different entry points. I guess I would say the two I think most helpful things for me personally have been one, learning about a topic and reading, all the documentation for a particular project, or reading about any writing that folks have done, and then trying to explain it to somebody who doesn't know anything about that project, or even just writing, so that you can clarify your thought. I think that's a great way just to learn about some of the principles. So whether you're learning about Ethereum or Bitcoin or like a DeFi protocol, whatever it may be, I would say just doing a lot of reading and then trying to put it in your own words, if to make sure you really kind of understand the content. That's the first piece. And then the second piece I would say is to go out and use as many products as as you're interested in, and actually go and test out some of these products if you can. There's a lot of cool hackathons that Karthik is really involved with on the ETH side, and just conferences where you can hopefully learn from not just the speakers, but also different attendees, and they can kind of bring you with you, bring you along with them, so you can find a bit more of a community. Because I think a lot of the learning within the crypto space comes from talking to other folks and kind of being able to ask your questions and whatnot.
Yeah.
Yeah, I might chip in. Notwithstanding global events of the past year, I've personally found that the best way to stay on top of stuff is to go to conferences, and it actually has nothing to do at all with like the speakers or the speaking tracks, and everything to do with seeking out the people who are working on the most interesting stuff, and just yeah, talking to them, getting to know them, figuring out what you're excited about, and talking, finding other people who are already, deep in the industry that are also excited about the same things. And I think that's, for me, been the best way to onboard into just everything that's going on.
I guess
sorry, go ahead.
resource, we, Women in Blockchain Boston and Sheet of 56. So if you're really a beginner, we released a beginner's guide to blockchain. Definitely check it out. It has tons of really easy to use and easy to understand resources for different topics within the blockchain space. Go ahead, Karthik.
Yeah, I was just gonna say, I think I don't have a lot of context on your background, Usman, but the kind of the most exciting thing to me about this particular space is that you can really kind of in a good way abuse the permissionlessness of this ecosystem, and kind of what I mean by that is the best way, which Kinjal said really well, is to really jump in and try things out. If you're a developer and if you're trying to understand how something works, the best way to do that is to play with it and see how things would work given different scenarios, and just kind of experiment with that until either you have a good idea or you know where you're stuck, and then you can kind of seek specific people to understand or clarify something better. If you're on the developer side, I think that gets even more powerful, and part of that is you have the ability to understand what's happening directly and see and observe it. Not only that, you can also actually play with it on your own. So anywhere from, if you're a developer, you can understand how a contract is set up. If you're excited about any single protocol out there, you can literally check out the source code. It is by default public in almost all scenarios. And on top of all of that, you may want to be you may be in a situation where you're financially not able to do so, and there's so many people who would rather not spend anywhere from gas costs for Ethereum transactions, if you're playing with DeFi, for example, to just having a lot of capital to play with these things. You can totally just clone the entire thing on your computer if you really wanted to, and have a whole private version of things where you get to control every variable and you can override things and just get everything started. And I just don't think any other industry or any other area of tech has that as a default. And it really kind of just makes it easy for you to boost your own knowledge on how something works. And not only that, you get to tweak and this sort of just playing God and messing with everything and being able to, in a way, bypassing time is a really interesting primitive that just wouldn't be possible anywhere else. And the other kind of thing is like if you're particularly interested in a specific protocol or a company in this space or any other open source thing out there, there's already like a 95% chance that there's a Discord community for that group or product or audience. And there's a few hundred people there just hanging out, and you can always just address any questions or concerns or just hang out with them. And they are extremely welcoming. And I've seen that firsthand. That's how I got into a lot of this as well. And yeah, just trying things out is the best advice and comment I can make.
All right, awesome. Thank you so much. I really appreciate your time.
Thank you for joining us. I know we are a little over time, but thank you all. David, do you have any closing remarks you want to make?
No, I think this was a great panel. Just want to thank everyone for being here. I think we had some good questions, and then just especially the parts where you guys went off the rails a little bit and spoke your mind. I think those were the most valuable moments to me, and hopefully to the audience as well. So yeah, just really appreciate you guys opening up and just being yourselves.
Awesome. Well, thanks for having and hosting, and yeah, this has been great. So thanks for organizing.
Yeah, and luckily nothing went wrong this time around with Twitter Spaces, so I'm glad. And we'll be doing more of these. So definitely, follow us, and you'll see a lot more of these happening soon. But again, once again, thank you to the speakers, and thank you everyone who joined us and listened to the session today, and for your amazing questions. See you next time.
Thanks, Nancy. Thanks,
Okay.
David.
Thank you.
Thanks, guys. Bye.
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 Here.